shares with put options are debt. Redeemable preference shares are debt. Compulsorily convertible debentures are now equity. The new accounting standard will fundamentally change how corporate India raises and invests its money. Hello and welcome. Today we mind the gap on financial instruments, and to do that I have with me Jamil Khatri, the head of audit at KPMG, and Sandip Khetan, partner at EY and also a member of the Indian Accounting Standards Implementation Committee of the ICAI. Gentlemen, to both of you, a warm welcome. Jamil, first up, just like in the case of revenue recognition, India is also amongst the first, if not the first, to adopt this new standard, which is actually IFRS 9 on financial instruments. What is going to be the ramification of that?
The current status on implementation around this is Europe will do IFRS 9, based on which our standard is based, in 2018.
Correct.
And the US is still deliberating the final model and when they will do it, which will likely be 2018 or beyond. So you're right, these are new concepts we have to deal with. The good news in my mind is, unlike revenue, because we have excluded banks and NBFCs from application of the new financial instrument standards, as far as corporates are concerned, there are a few areas which will pose a challenge, but in many areas the new IFRS 9 will be fairly similar to what the old IAS 39 was,
right.
And which is the framework which is globally followed for financial instruments as well.
Okay.
So this is not as bad as revenue in the context of the fact that we are having a limited application excluding banks and NBFCs.
Okay, but there is a fundamental change in how this standard looks at financial instruments. I'll start first with the basket of fundraising instruments, right? And in that, it's very clear now that you look at the substance of the contract as opposed to just the legal form of the instrument, right? Explain what that means, and then we'll start with what it means for, let's say, all kinds of equity instruments.
Yeah, so let me give you a very simple example. So let's say we raise preference share capital in India, and under Companies Act, preference share capital is always classified as part of share capitals.
Correct.
But when we look at any type of preference share capital, there is an underlying presumption that these will be redeemed in future, or these will be converted into equity, or there is a kind of return which is guaranteed to an investor. So the way Ind-AS looks at some of this, that is there a contractual obligation which is there with the issuer in a way to give return to the investor, and which he cannot avoid. If they cannot avoid, then this makes the whole instrument from an equity to a liability instrument. I think this is where it is fundamentally very different.
So from what I understand, plain vanilla equity stays plain vanilla equity, but equity with put options, as you were pointing out, Jamil, in the very first discussion we had on this series, will now be considered debt. Mandatorily redeemable preference shares will be considered debt, right? I want two perspectives on this. Are there any other instruments that we traditionally classified or categorized as equity under, sort of the Indian GAAP standards, and now that classification will change? And B, how will it impact strategic, financial or fundraising activities at companies?
Yeah. I think the biggest impact of this equity with put option, and that's an area I would like to focus on, is on private companies, which are closely held companies. We have seen that a lot of private equity investments that are made in startup companies have exit options, which provide that if a particular liquidity event, which is an IPO, does not happen by a point in time, then the investors have a right to put the shares back to the company. Those are liability instrument, that's debt. That's a big area of impact that we are seeing. We are also seeing a big area of impact, Menaka, where in group structures, and I mentioned this briefly earlier, where if you have a parent and you have a subsidiary and you want to create fundraising at the subsidiary level, you may sell it to a private equity, but once again you may assure the private equity of a return through a put option. That becomes a debt as well. So I don't think there are any other areas in terms of instruments, but equity instruments for private companies which have put options are a big worry.
And additionally, I think the return which we committed to the investor will now be a charge to the P&L. which today, it's all buried within the equity box itself. So that itself also will be a drag to the
this
profit
in a
and loss
sense is a
account.
disincentive to offer or to use any of these kinds of instruments, right? Because if you are taking a P&L hit on these instruments. So effectively, would you both say that when companies are looking at fundraising from here on, once Indian accounting standards is implemented, they are going to use less and less of these instruments unless absolutely necessary?
So if I can go first, last week we had a situation where a transaction fell through, where a major corporate was trying to dilute equity in newly formed business to a private equity. Private equity wanted a put option, which is very common. In the past, this would have gone,
Uncontested,
yeah,
or
absolutely,
not been a problem at all.
uncontested. But the deal fell through because the company understood the implication that this would be debt, and that creates its own consequence. So the short answer is, clearly there will be a change in the way people look at these instruments, how they negotiate these instruments. If it is essential, people will do it and understand the impact. But in many cases, we believe that people will reevaluate instruments like those.
So my view is slightly different.
Sure.
So I would like to categorize this into two types of companies. One is a listed company, which is more sensitive to your current set of shareholders, and the other one is an unlisted set of company, which is more looking to fund the growth. In that sense, I mean, they have limited ability to negotiate with a potential investor. So in my experience, and we've worked with many companies in that sense, where an unlisted company will agree, or company like a startup or anybody like that will agree with these returns, because they know if they're not going to do it, the other guy will not put in their money in the company. But if a listed company, like what Jamil said, that if they were to get into a subsidiary, carve out subsidiary and get a new investor, they may not now agree, because there is a bigger sensitivity in terms of their consolidated numbers and the ongoing communication with the existing investors as well.
That's equity with put options. But how frequently used are mandatorily redeemable preference shares? Are they a sort of frequently used instrument, and if yes, do you see their usefulness decline, or will people just come to terms with the fact that this is how it is?
Yeah, I think this is again very common, especially the redeemable preference shares are very common, and I think this will have people to think back, that do you really want to do this? Is there any benefit? Because now when you see preference capital also under the Companies Act forms part of your share capital and change your shareholding overnight, and this also becomes your subsidiary. So if now there is no advantage on the P&L side as well, why you want to do it, from that perspective. And we've again continue to see a lot of this because today you don't have to charge the preference share redemption premium to profit and loss account, and you get away with this. So a lot of companies, not directly in the main company, but a lot of down below companies, they have done these structures. Now they may not want to do this in future because there is no P&L advantage.
Okay, fine. Let's come to hybrid instruments, compound instruments, structured finance, however you want to term it. Here what I understand is you're going to have to separate out the various components, determine, again using substance, what is equity, what is a liability, and then accordingly account for that instrument. Where do you think the biggest impact is going to be, or the biggest change is going to be witnessed?
I'll merge that with a related issue. The basic premise here is every funding and every fundraise has a cost, which has to be reflected in the P&L. It doesn't matter how you structure it. So for example, if you raise, let's say, a convertible instrument, a convertible bond with a 4% coupon, the only reason the investor is investing in a 4% coupon bond is because there is a conversion option that will give the kicker or the benefit to the investor. What Ind-AS requires to say is that if you would have issued a non-convertible bond at the same time, let's say at a 10% coupon, that is the 10% that has to come into the P&L account. The differential of 6% is nothing but the value which is associated to the equity kicker that is built into the instrument. The net result of all of this, Menaka, will be that the cost to the P&L will be 10% and the balance amount will be attributed to the equity conversion feature. To extend this further, this is not just about hybrid instruments, but even otherwise in a plain vanilla debt. Today what a lot of companies do is they raise an instrument with a 4% coupon and the 6% is passed on to the investor as a redemption premium, which is the point Sandeep made earlier, and that 6% never shows up in EPS. That's charged off to the reserves, no longer. So I think the end game will be that whether you are a company that raises a convertible bond or a bond with a redemption premium versus a company that sources a normal backed financing at 10%, your cost in the P&L will be the same.
Okay.
So in a way, this will disincentivize company to do all of this structuring, because your P&L will be the same, whatever you may want to do, because it's going to, substance will overtake the legal form, and then, of course you save tax. If you do it plain vanilla, then tax is much easier to defend, right? So that way, this will disincentivize the companies to do any structured form.
Since you've already brought up the issue of debt, I want to bring in the changes applicable to debt instruments here as well. So I'm told that traditionally, or right now, compulsory convertible debentures or preference shares are tagged as debt. Here on, they will be tagged as equity. So there's a big change there as well, right?
Yeah, so I just want to highlight a little technical to say that if a compulsorily convertible debt is convertible for a fixed number of share at a fixed price, then only it will be classified as an equity. Okay, so if let's say it is convertible at a variable number of share or at a variable price in future, then it will continue to be classified as debt. Yeah, so assuming that it is fixed for fixed conversion, as we call it, then of course it will go to equity. However, if the company is under an obligation to pay a return to the investor, let's say on this debt I'm going to pay 10% of interest, then a company will require to again split the instrument, determine how much should go to equity, how much should go to debt, because this 10% is a contractual obligation which I cannot avoid. I have to pay this to my investor. So this present value of this 10% will be classified as a debt, and then you will get an interest expense on this balance portion. So we were dealing with this issue for a client, and see the negative of this now, what happens is that the amount of interest expense which will hit your P&L will be far less than what it is otherwise, and then you may have a significant MAT disadvantage.
So is there any way, and this question is to both of you, is there any way to try and understand, based on all the changes we've discussed, what instruments will become less popular here on, so where you see corporate India fundraising move to?
I think as we covered, and in summary, the way I would see it is, I think put options will become, people will become a lot more conscious. Redeemable preference shares will become a lot less attractive, and this whole structuring to really say that I will back end the return to you either as a redemption premium or through a conversion option, that will become less popular.
Yeah, so as we discussed, I think the way I'm going to say this is that in a listed company, or in a company where I'm answerable to my current set of shareholders, I think all of these structured instruments will be less attractive in future. But for unlisted company where I'm answerable to my existing new set of investors, because they know the cost. I mean, whenever that company will go out for an equity listing, they will adjust. I mean, all of this will convert, and hence it will nullify in that sense. So they may continue with this set of instrument, but for the existing listed company, I think they will be discouraged now to do this anymore.
I just want to just build on to one point that Sandeep made. What we are seeing is that even for companies which are unlisted and have these structures, they are relevant at a point in time, at an early stage. Many of our clients are talking to us 2 years before the IPO to say, now that we've reached a stage where that return or that assured return is no longer relevant, can we now kill those put options so that when we go IPO 2 years out, at least the last 2 years numbers will not have the overhang. I'm working on a IPO right now where the founder told me, I have positioned myself as a profitable company over the last 2 years. I don't care that this is a book entry, but if this cost is going to come as that and make me non-profitable, that is not something I would want. So it's just about being conscious and then doing that course correction at the right point.
Alright, so that sort of gives you a sense of what changes when it comes to fundraising. We'll take a quick commercial break and we'll come back and talk about the impact on investments. So which brings us to the next big basket of financial instruments that gets impacted, and that's investments, whether they're equity, they're debt, they're sort of structures of those. And essentially, I'm told here the big shift is to fair value, right? So if we could start first with equity, why you see the shift or how you see the shift to fair value playing out, especially if these are equity investments in unlisted companies, because that's where the valuation becomes challenging. But otherwise, it seems like a fairly easy transition to make.
Yeah, I think for most of corporate India, this will impact in two kind of key areas. One is investments in mutual fund units.
Okay.
Most mutual fund units today, Menaka, are classified as current investments and are carried at lower of cost or market value.
Correct.
And which is essentially cost, because the NAV generally keeps going up because they are debt instrument. Now this results in very funny accounting, because in many P&Ls, when companies report, they say this quarter's profits were higher because we had an FMP redemption coming in. The reason is because they're not able to record the increase in the value of the unit over time. The Indian accounting standards don't permit that. Going forward, these will be fair value, which is good because the yield adjustment comes over the period. So I believe that's a positive.
Okay.
On the other hand, the point you raised, a lot of Indian companies have unlisted strategic investments in other companies which are not subsidiaries or associates, because this does not apply to subsidiaries and associates. Right. In those cases, the current Indian GAAP is to carry it at cost, which is where now the change will be to fair value, and that's where some of the challenges of fair valuation kind of come in. And there's an additional complication on what you do with this fair value adjustment, which we can cover in the discussion. But the big impact is going to be on mutual fund units, and second is on unlisted investments.
Okay, but what does that mean if you were traditionally carrying these investments at cost? Today you're going to have to carry them at fair value. The chances are that it will be a positive adjustment in your books or a negative one.
So it can go both ways. It can go both ways. But of course, if you're sitting on a lot of unrealized gain on those investments, then it will be a positive adjustment to your net worth. And one of the other important thing we need to realize that all of these unrealized gain or losses, if there are any, will be adjusted through opening retained earning on transition itself. Okay. So all my existing investments which are sitting in the balance sheet of all the company, you need to fair value this on the date of transition. Then on an ongoing basis, depending upon the policy choice. So there is a policy choice which is also available here for my investment in subsidiaries and otherwise, where you take it to profit and loss account, or you take it to your, directly to balance sheet in a component called other comprehensive income.
Okay.
So there are scenarios where it may benefit the companies in terms of enhancing the net worth. There are scenarios it may result in.
And the choice is with the company?
The choice is with the company.
The question is on volatility.
Yeah.
Do you want volatility in your P&L or not? So if you carry it at fair value, it comes for the long-term investments. Just in our example, the entire movement in fair value will go through your P&L every quarter, and you'll have quarterly volatility in earnings. The problem now is, and this is a big change. This is one of the challenges of the new IFRS 9, which we brought in before the rest of the world. Is if you want to earlier, you could exercise the choice to say, okay, I don't want this volatility. When I do the fair value adjustment, I'll take it to my reserves, and when that investment is ultimately sold, at that point in time, I'll recycle it and bring it to my EPS. Makes sense? That goes away now. Yeah. So now under the new model, which we will adopt before the rest of the world, the only choice you have is volatility through P&L or permanently losing it in reserve, which means even when you sell the investment, the gain will not come to your EPS.
Okay.
So we will see, to my mind, based on our interaction, that most of the companies will possibly take a choice to take it to reserve.
Because that spares them the P&L volatility.
And that's not the fundamental business also. See, my business is not to drive earnings through my investment in treasury. But of course, for mutual fund, as what Jamil said, because it offers me a constant yield, I will take it to the P&L.
Can I bring debt into the conversation here? Can I bring intra-group debt, intra-group guarantees, inter-group loans?
Yes.
And therefore what the new standard means for all of this?
Yeah, I think debt is going to be extremely challenging for a lot of companies the way we see this. So today most of the companies simply account for it at historical cost or at amortized cost. Now what will happen in future, company will have to evaluate what are the features which are associated with this debt. So there are two type of tests which you need to do. One is called a contractual cash flow test, and the other one is called business model test. Contractual cash flow test means what are the risk which is there in a debt instrument. So fundamentally, if you look any debt instrument, you have a credit risk and you have an interest rate risk. So if if let's say these two risks are inherent in that any debt instrument, but if you have any, let's say, embedded conversion option, let's say if you have a conversion feature from an investor perspective, or if there is if the interest rate risk is not there, a lot of times what happens that the debt is issued at zero interest, in that sense. So then this test will not be met. So what the standard then says, debt also now needs to be accounted for at fair value.
Okay.
So if you fail the contractual cash flow test, it has to be accounted for at fair value through profit and loss account.
Okay.
So whatever the variability in the credit risk of the holder or the credit risk or the interest rate risk, that will go to my P&L. Then if it meets the contractual cash flow test, then you look at the business model test to say that what is my objective? Am I going to keep this debt till maturity, or I will end up redeeming this before maturity? Again, the way we see this, most of the corporate India will be very difficult for them to take a position that they will keep it till maturity, because there again business is not like banks. Their business is not to keep it for 20 years in that sense. Their purpose is to park the capital, and then whenever there is a capex which is going to come, or there is an acquisition which they want to do, or dividend they want to pay to shareholders, they want to sell it, right?
Yeah.
So they will again end up doing fair value accounting for all the debt instruments what they have in their balance sheet, and that will go to other comprehensive incomes. The fair value will go to again reserves, so it's not very intuitive. So equity fair value generally will go to P&L, but here fair value goes to reserves.
One of the other challenges we are seeing here, which again is not intuitive, is let's say a parent company gives a loan to a subsidiary at 8%. Which may be the rate which is permitted by the Companies Act based on the new rules, etc. But that may not be the fair value. That may not be the rate at which the subsidiary may otherwise be able to borrow from the market. Let's say their rate is 10% or 12%. Now, what the parent will then do in this case is say, okay, I should have earned 12% on this. I'm earning only 8%. The balance 4% is another form of capital investment in my subsidiary. So they will recognize interest income at 12%, get cash only of 8%, and the balance 4% will be treated as if they've invested in the subsidiary. Conversely, the subsidiary will recognize an interest expense of 12%, show 8% as being paid out, and the balance 4% as if the parent has contributed more to the capital.
Okay.
And so I think.
But in the days, in the age of transfer pricing, do companies still underprice their intergroup debt?
It does happen, Menaka, because people go by what are the minimum benchmarks laid down by law. So if the law says that you can do it based on the government securities rate,
says that the subsidiary would have been able to raise this money only at 12%.
yes.
I mean, you're anyways going to end up getting taxed on that. So wouldn't you rather just go with that 12% as opposed to doing an 8% transaction and then figuring out how to make it work?
So maybe that's exactly what you will do going forward.
Exactly.
But today that's not a consideration. You are able to prove to the tax guy. The problem gets compounded in this instance. If you have to do this notional, then you have a tax exposure as well, and therefore might as well do it at what is
now you have double the reason for why you should do it at the market rate as opposed to doing it at a subsidized rate, so to speak.
So this will in a way discourage companies.
Yeah. Sandip, in our previous conversation, you also brought up the issue of doubtful debts.
Yes.
Would that fall under this basket?
Yes.
Okay.
It's very interesting actually. So let me just give you a simple example. Let's say today I invoice to a customer 100 rupees for revenue. I expect that this guy will pay up in normal course. So let's say that is 60 days of credit period. And then I'm doing thousands of such transactions. So let's say I've got 1,000 homogeneous such transactions where I've invoiced every customer 100 rupees and I expect to pay. But we know based on our experience that some customers will not pay, right? But that I will get to know, let's say after 60 days have lapsed, that this guy is not paying up, and then what accounting standard requires me to do is to provide for that doubtful debt today. So I'm going to provide for this when the loss has already been incurred. So this is called incurred credit loss model.
Okay.
So now the new standard is saying, hey, you don't have to wait for the loss to occur, you have to actually preempt.
So how do you preempt a loss?
You preempt, so they've detailed out a formula, okay, in a way, well laid out kind of thought process, is to say, you look at your historical loss rate. So if historically you've been losing 1% of your sales as loss, that is one criteria. Then you look at what are the current condition. Is the business environment which you operate in today, is that business environment is strong, bad, ugly, neutral in that sense. You factor that, and then you also forecast. So you not only look at past, present, and also future, and then come out with a blend of your provision metrics and you provide for your bad debt today instead of waiting for the loss to occur. Intuitively, the way I look at it, this will double up your provision on transition.
This has not been tested. This incurred loss model, which is you provide for a bad debt when you have conditions of a bad debt, is well understood and applied globally. But this expected loss model, so it's not as easy as saying 1% is my credit loss. You have to stratify and say, depending upon the type of debt, depending on what really you are, what kind of customer. So you may have a situation for government debt, you may have a different play. For debt to a particular country, you may have a different percentage.
Modeling that
it is intensive modeling, and as I have said in the past, we will be the guinea pigs of the world because we will be the first kind of set of company that will apply it.
Okay. So if it was easy for me to get what the broader impact of fundraising would be, right? Certain instruments will become less attractive, some will become more attractive. That's where we'll see India Inc. move. How would I, summarize the broader impact on, let's say, investments of this new standard?
I think in addition to the mutual fund unit point and the equity we talked about, the one to look out for is provisioning for bad receivables, and then if you have subsidization in terms of any funding to a subsidiary sector, you'll see you will see that correction coming through.
Next week we continue to talk about financial instruments, specifically derivative and hedge accounting and non-traditional instruments.